What is going on, everybody? Crypto Ed here. Glad to be here with you all, and I'm glad to have Eric here. I'm Eric, aka the Cash Flow Doctor. He has a team of CPA working under him. So this is not just listening to one CPA, right? But we have someone who is leading a team of CPA, has a lot of experience in the crypto space. I mean, Eric is. I mean, I see you also wrote "wag me." We are all gonna make it. So Eric knows he knows crypto. He lives, breathes crypto. So I mean, there's no better person to have talking about crypto taxes than Eric. So Eric, the stage is yours.
Perfect. Thank you. And I appreciate your time. How's everybody doing? My name is Eric Niem. They call me the Cash Flow Doctor, and I run a crypto tax and accounting firm that serves founders, creators, NFT project launchers, and individual investors like many of yourselves in the crypto tax and the accounting side of the world in terms of doing bookkeeping, accounting, tax preparation, all the way up to acting as fractional CFOs for crypto-based companies. And so what I wanted to chat about today is something that I think is relevant on all of our lives right now. Just to give you a little bit of background, I am a complete crypto and NFT degenerate. Degenerate meaning most of my net wealth is wrapped up in the cryptocurrency, and some of you might be able to relate with that. And so as I've been in the tax space for over 13 years, and in the crypto space since 2017, investing since 2017, the one thing that I started realizing is there's a lot of confusion with regards to how crypto taxes are how they're going to operate and how you're going to pay your taxes. And at the end of the day, I know taxation isn't the most popular topic. However, it is something that's very important to talk about because, as we all know, there's two things in life that's guaranteed. And I'm going to be looking at the chat in the lobby and also the chat in the Zoom room. So as you have any questions, please let me know, and I'll be happy to answer them. But there's two things in life that we know are guaranteed, right? Ben Franklin said that you have death, you're guaranteed at some point in time, you're going to pass away. And you also have the guarantee of taxes. Now, this conversation is going to be mostly focused around United States citizens. Now, a lot of these concepts also apply to those who are overseas and in different countries in general terms of how you calculate profit, gain, and loss, right? But what we're going to talk about is mostly US-based taxation because that's what my firm focuses in. And just to give you a little background, I'm what we call an enrolled agent. So I focus on IRS representation. If you get in trouble with the IRS, I'm the guy that you hire to go represent you in front of the IRS. And then I have a team of CPAs that prepare tax returns for crypto investors and crypto founders and company creators just like yourself. So let's first start and talk about the fundamentals. The first question that a lot of folks always ask when it comes to cryptocurrency is gosh, Eric, you know what? Is cryptocurrency taxable? And if it's taxable, how's the IRS going to find out about my crypto holdings? So when it comes to taxation, you as an individual investor are going to pay tax in two different facets or formats in the crypto space. Number one, you're going to be paying tax on your capital gain, which is your net profit. So for example, let's say for you right now, Bitcoin, I know Bitcoin is the market's suffering right now. I know my pocket's crying just as much as yours, but let's say you bought Bitcoin at $45,000, right? That is what we call your basis or what you've purchased it for. And let's say, for example, you sold it a couple months later for $55,000. Right? So your net gain on that sale, and this is what we call a realized sale, means you actually sold it or exchange it for another token, or you swapped it into something. It doesn't necessarily mean that you've converted it to fiat or American dollars. But if you sold it, exchanged it, traded it, swapped it, no longer is in your possession, and you had a net profit of $10,000, you would have a capital gain, and you're only going to pay tax on this gain. A lot of folks always ask me, it's Eric, if I bought it at 45 and it's now 55 and I sold it, do I pay tax on 55? No, you only pay tax on the actual net gain, right? So you have option one, you pay capital gains taxes, and that's what most investors are going to participate in. Now, if you get staking rewards, let's say you're staking in Cardano, for example, or you get an airdrop. Like recently I have a ENS domain, And if you're an ENS domain, my ENS domain is EROCNIAM, my last name .eth. If you had an ENS domain prior to a certain period of time, you were airdropped the ENS token, right? So that will be treated as income to you. So let's say, for example, you were staking your Cardano, and your Cardano, the rewards that was paying out to you paid you $10,000 in rewards. That's going to be treated as, you could be either looking at as miscellaneous income, or you could treat it as interest that is earned. So those are two different ways of looking at how it's going to be taxed. And I'm going to break down the fundamentals of that, right? So AP asked the question, really one, do crypto exchanges report currently to the IRS? If you're using exchanges without KYC, how do exchanges know to report to the IRS? First of all, Coinbase at one point was subpoenaed by the IRS to issue 1099s to investors that had over $20,000 of transactions. As of this year, Coinbase is not going to report that. And I think they're going to be working on some consolidated way of doing that. And as you may have seen, the latest infrastructure bill that was recently passed, there's a clause inside of it that's very crypto focused. And what we're going to start seeing is, number one, more crypto exchanges, KYC, in US based are going to start doing tax reporting for the IRS. And this is a normal thing, right? So I know a lot of people are like, oh, cryptocurrency is decentralized. I get it. I completely understand. I'm a degenerate just like you. That being said, in America, when there is a net profit, when there is a net gain, you got to pay your tax on it. That's just the nature of the beast, right? Now, here is a secondary thing that a lot of folks don't think about, because they're like, oh, I'm going to put it in my MetaMask wallet and then do it through or Tornado Swap, and nobody's going to find this money. I don't think I would stand by that type of position. The IRS, just for context, has invested significant money, millions, I would say about $100 million into a project called Operation Hidden Treasure. And they've actually invested heavily in a couple of blockchain forensic companies where they can actually trace through the blockchain. And this is the power of the blockchain, right? We have this accounting ledger that's verifiable and traceable. They've invested heavily in these blockchain forensics companies to track and trace these transactions, right? So even if you are operating on an exchange that does not participate in KYC, or you're doing it in hot wallets or something like that, I still would highly, highly recommend taking the position of reporting as much as you can, as opposed to not reporting it at all. Because I'm going to tell you, I've been in the tax strategy world for a long time, and there is a difference between tax evasion and tax avoidance. What I'm going to teach is tax avoidance. How do you save on your taxes? Tax evasion, however, is criminal. And just like Wesley Snipes, as he figured out, puts him in jail for quite a bit of time. So when it comes to taxation of cryptocurrency, right, you have capital gains. And capital gains is what you're going to be paying tax on the profit of your transaction. Now, regardless, and this is a big question, regardless if you exchange it or you swap it for another coin, let's say you go from Ethereum to Dogecoin or Ethereum to Shiba on Uniswap, for example. And people are like, well, I didn't exchange it to dollars, so I shouldn't pay tax on it, right? That's not the case. The moment you release custody of that token, of that coin, you're going to need to report that. So same example, right? The 45,000 in Bitcoin. And then let's say, for example, you swapped it for Ethereum at 55,000. You didn't go straight to US dollars and then into Ethereum. You went straight from Bitcoin, from BTC to ETH. You would still need to reflect that $10,000 gain on your tax return as a $10,000 capital gain. So when it comes to capital gain tax, you have two ways of looking at it. You have short-term and you have long-term. And people always ask, gosh, Eric, are there any tax benefits for cryptocurrency investors in the near term? What do we do, right? So short-term basically means that you have a holding period of less than 12 months. And I would probably wager the majority of folks in the crypto space right now have only been in it since early this year. So any sales, any exchanges that have been happening are all short-term gains. Now, if you've been in the space as long as I have, or as Crypto Ed has been, and we've experienced a long 3-year bear market, and now we're in this great euphoria, which I absolutely love. You would have had long-term capital gains. And what's the difference, and why should I consider a short-term or long-term capital gain? Short-term capital gains, they are taxed at your ordinary income tax rate. Whereas long-term capital gains are taxed at either 0, 15, or 20%, depending on your income. So what is the comparison and how does it matter? Let's say, for example, you're an individual and in your normal day job, you're making $90,000 per year. Great income, right? So you're making $90K a year. As a single taxpayer, you're probably in a blended, let's just call it a 20% tax bracket, right? So if you were to sell your cryptocurrency transactions and you were to make $10,000 as a short-term capital gain investor, this would be taxed at 20% on your crypto, meaning you'd pay $2,000 in capital gain tax. Now, let's say, for example, you decided instead of selling this in under 12 months, you're like, gosh, I'm going to hold on to this for a year and 1 day. So that's what we call holding period. Let's say you bought it today, which is, I've lost track of the date, right? Because like these years are melding together thanks to COVID, December 4th. And let's say, for example, you've held on to this position in Bitcoin until December 5th of 2022. So it's been a year and 1 day. That would be considered to be a long-term capital gain. And at this income, you would only pay 15%. So a difference in holding period for this individual, if you held it for a little bit longer, would have saved you $5,000 in tax, right? So these are things to kind of consider and to, not $5,000, $500 in tax. These are things to kind of consider and think about when you are doing your cryptocurrency. And I want to be totally transparent. I do a lot of tax returns for crypto investors, and also a lot of folks out there that are in the space of teaching others about cryptocurrency. And by and large, the folks that buy and hold their cryptocurrency and look at the long-term capital gains, they actually do much better in terms of overall net performance than those that actively trade. I have one client. He does about 150,000 transactions per year using one of these cryptocurrency trading bots. And in his particular tax return, he net profited 100 grand per year, which just sounds fantastic. But 150,000 transactions that you have to track is very labor intensive. And the cost of accounting ate up quite a bit of his profit, right? So these are things to consider. Now, when it comes down to it, a lot of folks always ask me, is like, Eric, how do I keep track of my cryptocurrency transactions, right? Because we understand now that when you have cryptocurrency and then you either sell it, exchange it, or swap it, it creates a taxable event, right? How do I keep track of these transactions? So there's a couple of tools that I would recommend. And normally what you would do is you would either utilize one of these tools and create a report, or you would hire an accountant like ourselves, and then we would use one of these tools to link up to your wallets and then create an account, create tracking. So these are the 3 tools I recommend. We have Zone Ledger. And I'm not pushing any affiliate thing or anything like that. These are tools that I've used and I really enjoy. You also have Coinly. And then you also have crypto.com. The biggest challenge that we have as tax advisors and as individual investors is, how do you keep track of everything, right? Let's say, for example, you have 3 wallets, you're trading on Coinbase Pro, which I love, you're on Binance.us, and you're on Kraken, and then you have some stuff that's happening in MetaMask or Uniswap. How do you keep track of it all? And what I want to teach today is just a 10,000-foot overview for you to understand what's happening. But the reality is for many of you active investors, you may want to consider looking at utilizing a professional or utilizing one of these platforms or softwares to help you keep track of everything. These are all relatively low cost for crypto investors. I think the most expensive one is Zone Ledger at I think the premium is like $800, right? But it's unlimited transactions. So if you have active trading account and you have hundreds of thousands of transactions, you can run through here for a relatively low cost. And then what happens is these softwares would link up with the API, which is basically the data that comes out of these things. It will link up with the API and then spit out a an Excel spreadsheet that you could provide to your taxpayer, because the reality is most taxpayers don't really understand the crypto space. This is, again, a fairly new space, and it's a space that the accounting industry is still trying to figure out. Luckily, we got a team to do that. That being said, these are the tools that I would recommend utilizing if you are a cryptocurrency investor, because the biggest challenge is that reporting, right? Just like AP said, do any of these exchanges report currently to the IRS? And if so, like, how do we keep track of things? If you are investing in the traditional stock market and you're using Robinhood or Fidelity or Vanguard, and you're trading stocks, you're typically going to get what we call a 1099B. And maybe this will happen in the crypto space. I don't know. But it takes, it's taken a while for the securities industry to do it. You get 1099B that breaks down all of your stock transactions, your original cost or basis, your sale, and your net profit, right? And if it sounds like I'm jumping around the place, maybe I am. But that's what the securities industry has, but we don't have that in the crypto space. There's no standardized solution for it yet. And that's why you would use one of these tools or these platforms to help you do it. And I highly recommend it, because at the end of the day, when it comes down to it, you are individually responsible for your own tax return. And the reason that it's really important is if the IRS was to audit, let's say, for example, they're to do an audit of Binance.us, and they come to realize, hey, there's a couple of wallet addresses that we don't recognize here. Who are these connected to? And it comes up to be one of you that are listening in this beautiful this workshop. You're going to want to make sure that you could provide backup documentation of how you calculated your net profit. And at the end of the day, this is just like how it all works, right? So that's like in general, the 10,000 foot overview. Now, what I really wanted to share today is a couple of tax strategies, right? So these are the general basics, right? You sell, exchange, trade, you either pay a short-term capital gain or a long-term capital gain. If there's a loss, right now the market has a pretty large, it's bleeding red basically. You'll have capital losses that could offset your gains. And that's why in the stock market, people typically harvest their losses at the end of the year to offset the rest of your gains. And that's part of a tax strategy I'm going to talk about next. And then when it comes down to keeping track of your transactions, you would use a tool like Zone Ledger or Coinly or Crypto.com. And then that would create a report that would be given to either your tax preparer or could be imported into whatever tax preparation software that you're using, right? Those are the general things. So what I wanted to share now is like, how can you save a ton of money on your crypto taxes? I know that's probably the most important topic for all of us, right? Because we all understand, right? At this point, we understand that cryptocurrency can create taxable transactions. We understand that staking, airdrops, and all that stuff create taxable income. And now the question is, how do we minimize that tax, right? Now, as U.S. citizens, we all realize that, death and taxes are guaranteed. That's just the thing. So let's talk about, how do you minimize this tax? How do you pay the least amount of tax possible? So let's talk about a couple of strategies that you could implement today, or in the long term start implementing in your life. So the first thing I want to bring up is called loss harvesting strategy. Harvest your losses. And what does that mean, right? Harvest your losses. Loss harvesting is basically capturing the losses in your crypto portfolio, realizing it by selling your positions, and then now you have a loss to offset your gains. So let's say, for example, you did really well at the beginning of the year with Cardano or with Ripple, for example, right? And let's say, for example, you had over $100,000 in gains on your XRP position. And you're like, shoot, man, $100,000. And it's a short-term capital gain. And let's say you're in a 25% tax bracket federal and a 7% state tax bracket, that's 32%. That could be, you'd be liable for $32,000 of tax. And you're like, gosh, Eric, like that's a lot of money. It's back in the market. I've already deployed it. What can I do? Well, this is the perfect time right now to start looking in your portfolio. We're on December 4th at the time of this recording, and we still got a couple of weeks until the end of the year, where you might look through your portfolio and be like, shoot, I'm bleeding red in my position of, I don't know, let's talk about like some dog meme coin. I have a losing position in Shiba. And I know this is probably a sore topic for some. I get it. I invested in Shiba too. And let's say you've had a losing position in Dogecoin, right? But you're still holding on because you believe that this coin will go up. And I completely get it. However, this is an opportunity where, let's say, for example, in your Shiba position, your Doge position, each position right now, you're in the red by $25,000. You really believed in these dog coins, and I did too. I'm not going to lie. I'm a degenerate crypto investor or crypto person just like you. Let's say you had a $25,000 unrealized loss in Shiba and a $25,000 unrealized loss in Doge. Now, the question is, how do you take these losses to offset here? So you need to do what we call take a realized loss. Right now, if it's sitting in your portfolio, you're not going to have any taxable implication on it as it sits there. But that also means the losses that you built up in your positions, you're not going to be able to realize that in that year until you sell that position. So here's something to think about. What if you were to sell both of these positions today and realize a $50,000 loss? And I know people are always like diamond hands. You don't lose until you sell, all these things, right? But here's where it comes into impact. You have your $10,000 gain from Ripple, $50,000 loss from dog coins. You're only paying tax on 50 grand of the remaining net profit of the Ripple. So in this particular situation, you've cut your tax from, let's call it $32,000 to $16,000. Now you have this capital that's floating here. And what's really interesting, and you're going to want to talk to your individual tax preparer for your specific situation. Like everything I'm going to share is purely like informational. Do your own research as always. Right now, because cryptocurrency is not treated as a security and it is not treated as currency, there is no such thing as a wash loss in cryptocurrency. Meaning, if you were to rebuy these positions 24 hours later, and buy Shiba again and buy Doge again, and then end up holding that same position because you're diamond handing it, you'd be able to take that loss against here and you'd still be in the same position, right? So that is one option to kind of think about, especially right now when the market is bleeding so heavily, is to harvest losses. And then if you wanted to rebuy these positions, because there's no wash sales in cryptocurrency. Now that may be subject to change in this upcoming year because of the infrastructure bill. But regardless, here's a reason that, you can liquidate positions that maybe haven't been doing that well, and maybe you're emotionally connected to it. And now let's say, for example, this freed up $50,000 of capital, and then now you can just drop into ETH or something else. So this is just an additional little push for you to potentially, if it makes sense, to liquidate positions that are not just doing well for you, but also will allow you to harvest some losses to reduce your tax. So here's option one, and this is a way where it can reduce your tax liability by a substantial amount. Now, on top of that too, let's say right now you're super bleeding red because the markets are down 20, 30%. And let's say, for example, all of your losses offset your gains. So let's say, for example, in the same situation, when you took account of everything, you had the 100,000 in capital gains, and then you liquidated the rest of your positions. And yes, if you're outside the United States, again, this is all US based tax code. If you have $100,000 of capital gains, and then you also have $150,000 of losses, that's a $50,000 loss that is sitting on your tax return. Now you could use that $3,000 of the loss to offset your ordinary income. So let's say, for example, you made 50,000 bucks for the year. Now you're only paying $47,000. You're only paying tax on 47 grand. And then the remaining 47 of this 50 of the losses gets carried forward into a future year. So you could use those losses in future years until you spend them up, right? So harvesting losses is a great strategy for number one. Let's talk about another interesting strategy that I've used for folks that have built up large capital gains. This one is called the opportunity zone. Let me give you an example. I have a client. He had, when Polkadot initially launched, he put in $50,000 in Polkadot. And at the point of his exit, he had over $2.5 million in token from that, from the growth from when Polkadot ICO'd or initially coin launched to the point of like him saying, shoot, it's time for me to take my money out. So he had $2.5 million and he was stuck with the option, and it was a long-term capital gain. So he had 2.5 mil. And then for him, he was going to be taxed at 20% plus a little Medicare kicker, right? So his overall tax liability, 2.5 times 20, let's just call it $500,000 in tax. He had a $500,000 potential tax liability. So he came to me and said, Eric, that's a lot of tax. What can I do to reduce the tax liability? So I sat there and I asked him, I was like, okay, what are you looking to do with your cryptocurrency gains? What are you looking to do with it? He's like, well, I'd love to invest in real estate. I was like, cool. Okay. Do you have any areas that you've identified? And he's identified a couple of areas that I thought was really interesting. So I did a search, and those areas are what we call opportunity zones. So 4 years ago, there was a tax code that expanded called the QOZ, Qualified Opportunity Zone Tax Credit. And basically, if you're to invest in these opportunity zones, and there's 20 or 30,000 zip codes of this across the United States, lower income areas typically, and you're to invest into an area, you could either start a business or you could buy property and renovate it in those areas. You'll be able to defer your capital gains tax for up to 10 years. And if you held on to that property for over 10 years, when you sell or you exit, then at that point, 15% of the capital gains would disappear. Poof, it's all gone. And then you would have a step up basis. So what does that look like for you as an individual investor? Let's say you had $2.5 million, you cashed out your cryptocurrency, and you're like, Eric, I don't want to pay any tax on this. What do? We take that $2.5 million, and then we would create an Opportunity Zone LLC that would hold on to these assets. This LLC would buy real estate or start a business or buy a business. Let's say, for example, they have opportunity zones up in Los Angeles. They decide to open up McDonald's. You take this qualified opportunity zone to open up McDonald's in this qualified opportunity zone. And then now, long term, he would have saved 15% of the 20. So instead of paying $500,000 in tax, he's only paying $50,000. Right? Oh no, 5%. So he's only paying $125,000. So we have reduced his tax liability by $375. And then the business here in over 10 years, he would get a step up in basis. Let's say he buys this business at $2.5 million and it's now worth $5 million. He sells after 10 years, he pays no capital gain tax on that. Right? So we've reduced his income tax by $375, give him the opportunity to build more wealth for his family, build a business, and reduce his tax liability altogether. So that's called a qualified opportunity zone. And I'm just kind of like skimming the surface to give you an idea of what can be done. And these are questions that you want to ask your tax preparer, your tax professional. Hey, you know what? I've been investing in cryptocurrency. I've been investing in NFTs. I've had a capital gain. I've had all of these things that are happening to me. I know I have to pay my tax. How do I minimize or how do I lower my tax? What can I do right now to do that? Right? And hopefully your tax preparer is going to be able to explain, okay, here's a couple of things. We could do loss harvesting, or they might say, hey, you have a large gain. What do you want to do with it? Oh, I want to put in real estate. We could do qualified opportunity zones, right? There's some other tools out there like This one's probably the Michael Saylor option. And if you don't know who Michael Saylor is, he is a complete Bitcoin maxi. Bitcoin maxi meaning like he is all in on Bitcoin. And again, everything that I'm going to share is for informational purposes. So please see your professional tax advisor, unless you retain or hire a team. And also, these are United States based tax strategies, right? Every country is different, and I can only speak because my area of expertise is the United States taxes. So here's the Michael Saylor strategy. Michael Saylor's strategy is borrow against your crypto. Right? His whole concept is he buys Bitcoin and never sells it. So then at what point do you actually realize gains? And so let me give you a little bit of a tax strategy that the very wealthy do. The very wealthy accumulate assets. And that's why you see people that are worth billions of dollars. It's not what they have liquid, but it's what everything is worth to them. Now, the challenge is if they were to cash out all of their assets to realize that $1 billion, they wouldn't have that ability to continue being a billionaire. So same thing, as a cryptocurrency investor, you might be in a position where you have a lot of Bitcoin that you've accumulated. You might have been the guy that was the one who sold the Bitcoin pizza, right? When Bitcoin first came out and put in, I don't know, 10,000 coins or whatever for this pizza and Bitcoin. And you might be accumulating all this Bitcoin. I've had a client that was, he was a drug dealer back in the day, and he's cleaned up his ways. He went to prison and stuff like that. He's cleaned up his ways, but he used to sell, illicit drugs on Silk Road and was paid in Bitcoin. Lo and behold, he got out and he went his computer and he still had like, some Bitcoin in his paper wallet. And he came to me and says, gosh, Eric, I have all these built up capital gains. Like, what do I do with it? And so here's an option that Michael Saylor has, right? It's you borrow against your crypto. Basically, when you have the position, you put it in a tool like AAVE or in Celsius, for example, you borrow up to 50% of the value because the hope and the belief is that your Bitcoin is going to always go up in value. You borrow to realize some income from that. Now, but the thing is, loan proceeds are not taxable. And that's how the wealthy, Elon Musk and all that stuff, that's how they're able to have their living expenses paid for and do whatever they want to do. They borrow against their assets, right? So this is a strategy that a lot of like very wealthy people utilize, and a lot of like big crypto whales do. Instead of cashing out their assets, right? Because over time, the tokens, they have the strong belief that the tokens are going to go up strongly in value. Let's imagine you got an Ethereum at its ICO price, and now it's gone up and down, right? But now it's at $4,000 per token. Now, if you're a big believer in cryptocurrency like I am, you might speculate and believe that Ethereum is going to go to $10,000 within the next 12 months. If that is your belief, why sell that Ethereum and realize that tax liability and now have much less access to capital? Instead, why not borrow against it? And again, this is a strategy that is only for some, not for all. I'm just proposing some strategies and some things to kind of think about as a tax planning tool. But what if instead you borrowed against it, you still had the realized gains from it, or the unrealized gains as it appreciates in value, and you're still providing yourself and your family and your loved ones with some money to operate your household on, right? So that's the Michael Saylor strategy, to borrow against your crypto. Loan proceeds are not taxable. That's another way of eliminating or getting around the income tax in a completely legitimate legal way. And then the last way of getting around or minimizing your tax liability is what we call a charitable remainder trust. Charitable remainder trust. Now, this one is a little bit more complicated, but what it is it's a very specifically designed entity that you could park your assets into. It gives you an annuitized amount of income every single year. And then when you kick the bucket, the rest of it gets donated to charity. This works really well for investors that aren't looking for immediate capital. They're looking to just turn their asset into a cash flow or an income stream for them for up to 20 years. And then when they die, then the rest of it gets donated to a charity. And what they end up getting as a benefit up front is a large charitable deduction on their tax return. Why is this really important? So this is really important because, number one, if you're really heavily in the blockchain space, the decentralized economy, many of us want to do things for more than just economic reasons. We want to do things for more charitable reasons, right? We also want to do things that will allow us to minimize tax, but also provide us an income. And so here's a really unique way of doing it. Now, this one is something that needs to be said by an estate planning attorney. And it's usually something I just help guide people along the process. But basically, it creates a trust that now holds on to your crypto assets. This trust either liquidates it or keeps it inside of there. And it creates a predetermined annual income that's paid to you and your loved ones. And in the document, just like any other trust, the moment that you either pass away or something like that, then the remaining balance of the assets in there gets donated to charity. Now, what's really neat is you could receive the charitable deduction up front. So let's say, for example, you put $1 million of Bitcoin into this charitable remainder trust, you would get an initial charitable tax deduction of $1 million. Now, the charitable remainder trust would liquidate the asset and pay you an annual income of that 100 grand, of that $1 million. And then when you pass away, everything gets donated to charity. But the big benefits up front is you get that huge tax deduction, which is fantastic. And then you also get in predictable annual income. So here are a couple of strategies, right? There's a couple of other ones to maybe consider if you are an active trader. If you're an active cryptocurrency trader, meaning this is your full-time job and this is like what you actually do for a living, you also have professional trader status. And what is professional trader status? To the IRS, professional trader status basically means that you are actively trading cryptocurrency or stocks or bonds or options or whatever in a professional manner. You're doing more than one transaction per day. This is not being run automatically through a bot, right? This is how you make your living. So if you're a technical trader, you're doing trades on an active basis as your main source of income, you may want to look at professional trader status. What it allows you to do is it allows you to take expenses against your cryptocurrency gains. What do I mean by expenses? Professional trader status means you're operating as a business. So you could deduct your home office, like this office that I'm in right now. You could deduct your computer, internet service, cell phone. If you go to Art Basel right now, or you go to NFT NYC or any of these events, all those expenses are now deductible as a business owner. Now you have to qualify for this, and you have to have your tax professional send in an election or a letter to the IRS with the tax return to explain the position. But let's say, for example, you had, I don't know, $100,000 for the year in capital gains. But your professional trader status, between all the software tools, the travel, your cell phone, computer, all of your research, you're spending 30 grand a year in expense. You're only going to pay tax now on 70 grand. So we've cut your tax liability from, let's say 100 is $20,000. We've cut it to 70,000. So you're paying tax on 15,000, for example, right? So here's an example of like being able to reduce your tax liability by treating your trading activity as a business. So that's a really unique one that I have a couple of clients do because that's their main active business, right? Now, this also applies for if you are a miner and you're mining as a business owner. So let's say business owner. So you can kind of see, right? Like there's a number of things that can be done as a cryptocurrency investor, trader, or miner that can help you reduce your tax liability. And the challenge is most folks in the accounting space don't really understand what we do. And to be frank, right, the crypto space moves so fast that even us in the crypto space don't always necessarily understand what we do, right? So imagine trying to explain to your taxpayer, hey, yeah, so I had sold a JPEG of a monkey, of an ape, and it looked really bored, and I made $200,000 on it. Imagine explaining that to your accountant. Your accountant's like, what did you do, right? But that's the space that we live in, right? With NFTs, for example. So let's say if you're a miner or you're a business owner and you're operating your crypto activities as a miner, right? If that's the case, you can offset your income by your expenses, right? So these are things to kind of consider. Again, my whole objective, trying to talk about crypto taxes in under an hour is very challenging because there's so many things that can be done. My objective today really is to scratch the surface, give you an idea of, yes, there are things that you can do as a cryptocurrency investor. There are things that can be done to plan proactively to minimize your tax. And there are things that can be done on a spicy level by being a little aggressive, that still plays within the context of the law and allows you to minimize how much you pay in tax. And that's really the name of the game, right? Like the way that I look at taxation is a game. And the reality is we understand that paying taxes is required by the IRS, but paying the least amount of tax legally, that is a duty for every American citizen. How can you minimize your tax legally? How can you be in a position where you can be audit proof and do things properly, but pay the least amount of tax possible? Because, for example, if I could show you a way of saving $20,000 in tax, where you can do it $20,000, I don't know, you might spend it on your family. You might go on a vacation. You might enjoy that. You might save it for your kids' college education. You might invest it back in the market. But that's better than giving the IRS or the federal government or your state government $20,000 more than they really needed to get. Because where are they going to spend the $20,000 on? I don't know, $2,000 toilets in the military, a missile that gets shot overseas or something like that. It seems like a colossal waste. So these are the things to kind of consider. So as we like wrap this up, I wanted to see if there's any questions from anybody out there with when it comes to cryptocurrency taxes. Is there any like confusion or anything to kind of keep an eye out for? And again, you could put all of your questions inside this chat box. But as I look at the screen for any questions, what I'm going to do is I'm going to talk about a really quick situation, in-person situation that I had recently dealt with, right? And this is on the NFT side, because as I noticed, Ed's had, some amazing presenters, and a lot of them were talking about NFTs. So after the end of this last tax season for me as a professional is April, I decided to give myself a little bit of a splurge purchase. So what did I purchase? I purchased a Bored Ape Yacht Club image, right? A Bored Ape Yacht Club on OpenSea for 0.5 ETH. I wasn't in, unfortunately, at the mint or at the issue. I wish I was, because I would have minted the crap out of this thing. But I bought one that was leopard print for 0.5 Ethereum. And at the time in April, that was about $1,500. And to me, that sounded like the most ridiculous purchase ever, but I bought a Bored Ape Yacht Club, a $1,500 one. And of course, hindsight is 2020. So what ended up happening to me was in September, if you're in NFTs, you remember that Bored Ape Yacht Club had a drop of mutants. So in September, I ended up having offers on my Bored Ape Yacht Club, and I ended up selling it for 50 ETH. And then now I was like, shoot, that's a lot of money, but also that's a lot of tax. So 50 ETH at the time was $200,000. And this is a lesson for all of you that are out listening in this audience, right? So right there is a massive net profit, which many of us are thinking, man, that's a lot of money. You did really well, Eric. And yeah, I did. I completely agree. But now I had an income, an additional income for me of $198,500. Now, what I should have done as a tax professional, and this is a mistake that many people do, is when you have that 198, you're like, dude, that's amazing. I'm going to do whatever with it. What you're going to want to do and start considering doing as you become more and more active in terms of your trading and in terms of the thing that you're doing is you're going to want to start setting aside money for the tax and either prepaying as an estimated tax payment to the IRS or setting aside in a specific account purely for tax purposes. What I should have done is I should have set aside 30%. Short-term capital gain, high tax bracket. I should have put aside, I don't know, 50 grand. That's what I should have done. And why do that? Because I could have deployed that into other assets and stuff like that. Totally. Now I'm in a position where I've reinvested a lot of this back into NFTs and in the crypto and all these other things, and it's all locked into assets. For me now to go and to take this money out, I'm going to have to liquidate assets in order for me to pay my tax, right? So as an investor, yes, you can make a lot of money in the crypto space, but what you're going to want to do is you're going to want to be proactive. You're going to want to be able to make your profits, make your gains, and set aside money. Ideally, what you're going to want to do is put this in a savings account or send it as a quarterly payment to the IRS. So it's out of sight, out of hand, and then you reconcile at the end of the year. But just do know that, like, you know, in this space, WAGMI, we're all going to make it. The things that you want to consider is even us as tax professionals, the space moves so fast. Things happen in here that, you know, the IRS doesn't really recognize or understand yet, staking, airdrops, and all these things that you're going to want to talk to a tax professional on a regular basis or have somebody you could chat with. Let me just drop my Twitter for any of you that want to reach out to me or ask me a question after this. It's erock Niem, NGHIEM. That's my Twitter. And then my Instagram, and both you could slide in my DMs and ask me questions, is the Cashflow Doctor. Okay, let's see. We got a question here. Ed, a Facebook question. If I enter into LP position, a liquidity position, right? Is that a taxable event? How about wrapping a token from one network to another? So that's a really good question. Typically, when you enter into a liquidity position, there's a pairing that happens, and some are just one-sided, right? But the liquidity pairing, you have to put in an equal amount of dollar amount of token of, let's say you do a Matic Ethereum pairing. And let's say you start with Matic as your main coin. So when you put it in, at some point, you have to exchange part of that Matic for Ethereum. That constitutes a taxable implication because that swapped from Matic to Ethereum. And then now you have this liquidity position that's sitting inside of whatever it is. Maybe it's Uniswap or something like that, right? So you have this one taxable transaction from the swap of Matic to Ethereum, and now it's sitting inside of here. Now, here's the challenge when you're a liquidity provider is sometimes you may have impermanent losses. And so the challenge with that is now, let's say you liquidate your liquidity position and you exit from it, you're going to have to reconcile, or your tax software, your taxpayer is going to have to reconcile if there was a change or shift in your position of that token. Let's say you started with, I'm just going to say, and these aren't equal, but let's say you start with 50 Ethereum and 50 Matic, right? And then when you liquidate a position because of impermanent losses, you had 25 Matic and 75 Ethereum, which sounds great. And I mean, I would love for that to happen. But let's say that was to happen. Somebody needs to reconcile the shift in the income or the shift in the gains. And there might be large losses that can be offset, which would be fantastic, or there might be a gain in there that may not have been considered. So there's a lot of moving pieces, but when you do create a liquidity position and the pairing happens, part of your token, if it gets swapped at that point, can constitute a taxable transaction. So yes, it could be. Lily asks, is there any possibility to cash out crypto to tax-free country to exchange? If yeah, I love that question, right? You're proactively thinking. There's a couple of countries that are very like crypto friendly, like Portugal and stuff like that. A lot of folks have been thinking about moving to Puerto Rico. There are a lot of caveats to it. Let's quickly talk about them. Let's say, for example, you want to move to Portugal because of the amazing adoption of cryptocurrency, or Sweden or Switzerland or Singapore, any of these other countries that are very crypto friendly. The challenge is if you are a US citizen, US citizens are taxed on income globally, not just in the United States, globally. So even if you were to move your assets to Portugal and live in Portugal for a year or two, if you maintain your US citizenship, the US still wants its pound of blood. So what do? Let's say, for example, you've decided that you don't want to pay tax on this income and you want to move out of the country. The only way around it is you have to relinquish your citizenship to the United States, which comes with a lot of challenges and a lot of things to consider. But mostly the biggest thing you consider is there's an exit tax. When you relinquish your US citizenship, and this is not a decision to take lightly, but it is a tax strategy conversation. When you relinquish your US citizenship, the United States is going to take a financial statement from you and figure out all of your assets and determine what tax they need to collect before you move out of the country. So those are things to consider, and that is something you're going to want to have a conversation with an international attorney. Now, another question is, a lot of folks are like, I don't want to give them my US citizenship. Like, my kids live here, my kids go to school here, or my parents all live here. What do I do? What about Puerto Rico? Guys are moving to Puerto Rico. The challenge of Puerto Rico, if you were to utilize Act 2123 or any of these other investor acts, it's fantastic. And when you're in Puerto Rico, your capital gains in Puerto Rico are tax-free, right? Or they're highly minimized. I don't know the exact amount off the top of my head because it's Saturday afternoon and we're coming close to the tail end of it. But the way that it works is when you move into Puerto Rico, this is something to consider, because I hear a lot of folks say, I'm going to move to Puerto Rico, and that way I can avoid these taxes, right? Puerto Rico, challenge of Puerto Rico is when you move into Puerto Rico, there is a timing consideration of your asset. Let's say you have a $500,000 portfolio. And when you move to Puerto Rico at the time, you have 400,000 of unrealized gains. Unrealized means it hasn't been sold. And your whole strategy is, well, I'm going to move to Puerto Rico. I'm going to live there for a year because I need to be at least 6 months in a day and it needs to be my domicile. And that way I'm going to avoid these taxes. When you move to Puerto Rico, these unrealized gains also come with you. They don't become realized. They don't disappear. They come with you. And then now let's say, for example, after 12 months, because everyone's like, I'm going to live in Puerto Rico for a year, then I'm going to sell my assets. After 12 months, your portfolio is worth $575,000. And at that point, you liquidate. You're like, I'm cashing out, taking all my money, living on the beach, right? Problem. This $75,000 of the appreciation when you're living in Puerto Rico, that has a very substantially reduced capital gain tax. Yes. But the IRS and the federal government are still going to want their tax on $400,000. And this is the one thing that a lot of crypto investors aren't really thinking about, because I see guys moving to Puerto Rico. They see Brock and his crew creating their own crypto community, which I absolutely adore and I love. And I think it's fantastic. But a lot of people don't realize that your basis and your gains track with you. And if you sell a year from now, 10 years from now, 20 years from now, the IRS and the US federal government is still going to want their piece of this pie. It doesn't just automatically dissolve. So hopefully, Lily, that answers that question. There's a lot of complex tax structures out there that some people will advocate and sell you. The challenge with it is many of them are not audit proof. You're going to see a lot of folks out there that are going to market to you putting your cryptocurrency into some sort of a trust to mask your identity and sell it into, these are all what we call abusive trusts. And I represent taxpayers all the time in audit, trying to defend on these positions. And these are not positions that I would take after seeing how the IRS treats it, right? Same thing, international stuff is very risky unless you have a really good international attorney and they are helping you take care of the exit tax. So hopefully, again, my objective today was to kind of help you scratch the surface to understand that there are things that can be done. Yes, cryptocurrency is taxable. Yes, airdrops and staking can be taxable income to you, but there are things that you can do as an investor, as a business owner to help you minimize that tax. So again, my name is Eric. They call me the Cash Flow Doctor. Hit me up on Instagram at the Cash Flow Doctor or on Twitter at eRockNiem, NGHIM. Hopefully I was helpful. If you got any questions, holler at me, holler at your boy, and I'll be happy to answer any questions for you.